Let's look at 10 important investing principles and how they can benefit your portfolio. First is that asset allocation is the most important determinant of your investment returns rather than the specific stocks that you are invested in. Equities have delivered long-term returns in excess of bonds, gold, or property. And so by allocating the majority of your wealth towards a risk-on asset, you're likely to have decent returns, although you might have a lot of volatility along the way. And I agree with Warren Buffett's advice to his wife upon his death, which was to be invested 90% in the S&P 500 and 10% in US government bonds. And if you take the view that you've got like a 30-year retirement and then your 10% in bonds, then you've got kind of 3 years worth of money in a risk-off asset, and hopefully you can use that to weather the storm. You need to be fishing in the right pond, and you need to have enough of a risk-off asset such that you don't sell equities during a market crash. The second point is that costs matter. As Jack Bogle says, you get what you don't pay for. And because we're concerned with costs, that's why we don't bother with a financial advisor. If we're looking for something to invest in, we're looking first at the lower cost passive alternatives, see how well they do, what they include and exclude, and that's the basis for the start of our research. There are no guarantees that higher fees will lead to greater returns. And if you look initially at trackers, you're going to have something that's market cap weighted, and it should have the winners in over time. It will have natural selection going on such that the best companies are rising to the top of the fund. When markets are performing badly, a lot of people tend to regret the performance fee they paid to the fund manager when everything was doing well and there was a massive bull market. Third point is that diversification in terms of sectors, factors, and possibly geography is important. Things like technology can have excellent long-term trends, and quality as a factor in terms of things like strong balance sheets and good profit margins can also be a useful addition to your portfolio. But if all your funds have this kind of bias to them, there is a risk that they can all go down at the same time. If all your funds are doing well at the same time, it might be important to look at the correlations that you have between your holdings and just be wary of what's going on, that it might be valuable to add in something that is potentially less correlated, that can give you some sort of protection if there are some market corrections around certain areas of the market becoming overvalued. The fourth principle is that markets are broadly efficient, and for this reason it's difficult to beat the markets consistently. Recently, funds that have done well have had a bias towards technology, but there's no guarantee that the outperformance of technology will continue into the future, and you might find actually that the trend reverses and that technology underperforms the overall market. So sometimes jumping on a trend is not an advisable thing to do. A top performing fund one decade can become an underperforming or mediocre fund in the next decade. With this channel, I put a lot of effort into finding the top performing funds, into analyzing them in a lot of depth and trying to find out the true reasons for their outperformance to give me some confidence that this might continue into the future. But I do review my fund selections regularly to make sure they're performing in line with my expectations. Principle number 5 is that risk and return are inextricably linked. To obtain higher returns, you have to take on more risk. And this is most clearly evidenced in the bond market, where if you want to get more returns, you have to accept a longer duration on the terms of the bond, or a greater risk of default by the counterparty. So corporate bonds have a higher yield than government bonds. Emerging market government bonds have a higher yield than developed market government bonds. So the whole bond market shows strong signs of market efficiency, which we discussed earlier. And then in the equity market, if you're getting good returns, then the problem is you could be taking on a lot of risk with something like maybe semiconductors, and there's a possible bubble forming. So you need to be really careful with positions that are doing well if you don't fully understand the dynamics of that market. So this brings us to principle number 6, which is that there is no substitute for detailed research. You'll always need to know exactly what you own. Always read the fact sheets about a fund, but you need to understand that a lot of information coming from the fund is just propaganda. So you also need to read around the market dynamics where the fund is invested. Have a bias towards exchange-traded funds that reveal all of their holdings and also give you data such as the price-to-earnings ratio of the fund so you can check when it's under or overvalued. It can be difficult to distinguish between luck and skill of a fund manager. And with so much money at stake, there's a lot of spin when it comes to what is written about actively managed funds. Number 7 is that alternative assets such as infrastructure, private equity may add little in the way of risk-adjusted returns to your portfolio. Alternative assets boomed when interest rates were slashed following the global financial crisis. Returns on bonds plummeted and money piled into property, infrastructure, private equity, hedge funds, all kinds of things, esoteric assets such as solar or wind. A lot of these assets took on a lot of debt behind them, which leveraged up their returns. And then recently, when we've seen interest rates rise, then the returns of these assets have fallen. And a few of these assets have proven to be a lot higher risk than was initially anticipated around things like storage, song royalties, or social housing. Private equity can perform well in a bull market, but in a bear market, the returns can be absolutely horrible. Private equity firms talk about their successes and they bury their losses deeply under the carpet. And I think that funds that have a mixture of assets in them are often confusing for an investor to really understand what is driving the performance. So I prefer more pure played funds that are either solely equities or solely bonds, and it's much easier to see what's actually going on. Principle number 8 is that investing in individual companies can be very tricky. If there are over 2,000 companies listed on the UK Stock Exchange, then how do you know which ones to invest in? People are often just taking a little snippet of information and using that to form the basis of an investment decision. So they like a high yield, or maybe the price has collapsed recently and they think it's overdone. They maybe like the growth prospects of the company based on some very bullish news. But the fact is that they're not really doing a lot of back testing to see what happened in the past if they'd invested in similar companies that were in similar situations. One way around this is to own what you know, and maybe have a bias towards companies where you are the customer and you really enjoy their product. Having said that, I'm a customer of Metro Bank, and if I'd invested in that, it would have been a horrible investment. So you've got to do the real detailed forensic research to get comfortable around the company and what's going on. For that reason, I'm not always that interested in investing in individual companies because I think it's too time consuming and it can add a lot of volatility to your portfolio. Principle number 9 is that each fund in your portfolio should have a specific objective. Hopefully this avoids holding too many funds that simply duplicate each other, and it gives you an ability to streamline your portfolio. It also makes it easier to have conviction holdings. A complicated portfolio will take up a lot of time in terms of reviewing what's going on, and it can also lead to a lot of trading costs. It's important to review your holdings on a regular basis, and I'm looking to do some quarterly updates on some portfolios that I've put together in a previous video. Principle number 10 is to take a long-term view. Give each fund the time to perform as it's moving through its own economic cycle. Periods of underperformance are inevitable, and it's important to stay invested during these times. If you've done your research properly, if the fund has a specific goal within your portfolio, then it's going to become much easier to retain it. If you follow all of the principles of this video, you should end up with a strong core holding or holdings within your portfolio, and then some satellite funds around the edges to provide that extra diversification to help smooth out the returns. And overall, your portfolio will have a good risk-reward profile. If you want to learn more about what I've discussed in this video, go to the portfolio coaching section of my website, ianshadrack.com.